Every time you tap your credit card, something strange happens. Money moves. Data races across the world. Banks talk to other banks. And in less than a second, someone decides whether you're trustworthy enough to be approved. But here's the part most people don't realize. When you use a credit card, you are not spending your own money. You're borrowing someone else's. And if you don't understand how that works, it can quietly cost you thousands. So in this video, I'm going to explain exactly how credit cards work, what's happening behind the scenes every time you swipe, why banks push them so hard, and how interest is where things can either work for you or trap you. Let's start from the beginning. A credit card is not free money, and it's not extra income. A credit card is a short-term loan. When a bank gives you a credit card, they are basically saying we trust you enough to borrow our money up to a certain limit. That limit might be $1,000, $5,000, or much more. That number is your credit limit. It's the maximum amount the bank is willing to let you borrow at any one time. Every time you use your credit card, the bank pays the business for you. You then owe the bank that money back. If you pay it back on time, you usually don't pay anything extra. If you don't, the bank charges you interest. And interest is how credit cards become expensive. Now let's talk about what actually happens when you tap your card. Imagine you buy a $5 coffee. You tap your card on the machine, and within seconds, several things happen behind the scenes. The card machine sends your card information to the business's bank. That bank contacts the card network, like Visa or MasterCard. The card network then contacts your bank. Your bank quickly checks a few things. Do you still have available credit? Is your card valid? Does this purchase look suspicious? If everything checks out, your bank approves the transaction. The coffee shop gets paid. You walk away with your coffee. But the money didn't come from your bank account. It came from the bank's money. You've just borrowed $5. Now here's where credit cards feel different from other loans. You don't have to pay back each purchase straight away. Instead, credit cards work in cycles called billing cycles. A billing cycle usually lasts about 30 days. During that time, all your purchases are added together. At the end of the cycle, the bank sends you a statement. This statement shows everything you bought, the total balance, the minimum payment due, and the due date. This part is critical. If you pay the full balance by the due date, you usually pay no interest at all. This is called the grace period. That's why some people use credit cards every day and never pay interest. But if you only pay the minimum amount or miss the due date, interest starts being added. Credit card interest is shown as an annual percentage rate, or a PR. You might see something like 20% or 25%. But credit card interest is usually calculated daily. The bank takes that annual rate, breaks it into a daily rate, and applies it to whatever balance you didn't pay off. Every day, then the next day, interest is charged on the new total. This is called compound interest. It's how a balance that doesn't feel that big can slowly grow into a serious problem. This is also why banks love credit cards. They make money in three main ways. First is interest. If you carry a balance, you are paying to borrow their money. Second is fees. Late fees, annual fees, and penalty fees add up fast. Third is merchant fees. Every time you use your card, the business pays a small percentage to the card network and banks. So even if you never pay interest, banks can still make money from you just by you using the card. Now let's talk about minimum payments, because this is where many people get stuck. The minimum payment is the smallest amount the bank allows you to pay to stay in good standing. It's often only a small percentage of your balance. Paying only the minimum keeps you out of trouble, but it also keeps most of your balance growing with interest. If you only pay the minimum every month, it can take years to clear the debt and cost far more than what you originally spent. Credit cards also affect your credit score. Paying on time helps build trust with lenders. Keeping your balance low compared to your credit limit helps too. Missing payments, maxing out your card, or carrying high balances can hurt your score and make future loans more expensive. So are credit cards good or bad? They're neither. They're just a tool. Used properly, they can help you build credit, manage cash flow, and even earn rewards. Used without understanding, they can quietly pull you into debt that's hard to escape. The key is remembering that every swipe is a loan. Every statement matters. Interest is always waiting in the background. So next time you tap your card, remember this. You're not spending your money. You're borrowing it. and how you pay it back is what decides whether a credit card works for you or against you.